The 2025 market delivered strong headline returns, but the experience underneath was uneven and often restrictive for active traders. From a distance, it reads as another strong year. From inside the tape, it was a market that rewarded patience, punished urgency, and required strict selectivity. The S&P 500 finished 2025 up just under 19%, marking a third consecutive year of gains. That outcome, however, masked frequent interruptions. Sharp pullbacks developed with little warning and were often followed by fast rebounds that offered limited follow-through. Policy headlines and macro releases injected short-term volatility, even when the broader trend stayed intact. For swing traders, sustained directional trends were uncommon. Many moves began cleanly but failed within days. In that environment, early entries carried higher risk, and confirmation became a necessary filter rather than a preference. Trades that lacked structure or invalidation tended to resolve quickly against the position. Looking ahead to 2026, the starting conditions are different than they were entering prior years. Valuations remain elevated, liquidity conditions are tighter, and policy uncertainty is unresolved. That combination argues for restraint rather than expansion of risk. All major indexes ended 2025 higher, but leadership was inconsistent. The Nasdaq led with gains slightly above 20%, driven by a concentrated group of large-cap names. The Dow advanced at a slower pace, while the Russell 2000 struggled to sustain momentum outside of brief rotations. Large caps continued to absorb the majority of capital flows. The S&P 500 recorded dozens of record closes and pushed above the 6,900 area late in the year. Importantly, index strength often exceeded the quality of setups available underneath the surface. Breadth narrowed during several advances, increasing the risk of sudden reversals when leadership stalled. Sector performance reflected that same dynamic. Communication services ranked among the stronger groups, supported by advertising recovery and continued demand for AI-related tools, while regulatory risk remained a constant overhang. Financials were led by large banks, where earnings stability and balance sheet quality mattered more than broad exposure. Industrials benefited from aerospace, defense, and infrastructure spending, though tariffs and labor constraints limited upside visibility. Utilities shifted from a defensive profile.